Like 6 months later, they almost doubled their value. I mean, how does any of that make sense?
Very competitive industry. They've got PayPal, they've got Adyen.
It seems to me kind of like they're probably setting themselves up to just do a direct listing rather than an IPO. Stripe has just announced raising $250 million at a $35 billion valuation, which puts them as one of the highest priced or highest valued tech companies in the world. And here's the crazy thing about this. Literally, earlier in 2019, they were valued at about $20 billion.
Right.
And so, like 6 months later, they almost doubled their value. I mean, how does any of that make sense? Make sense to you?
I think they've done a good job building their business on app developers and basically capitalizing on that whole economy. They facilitate payments. They're the payment gateway, basically, that handles a lot of that stuff. I don't see how they doubled the value of the business in 6 months. It's a very competitive industry. They've got PayPal, they've got Adyen, and a few others out there that they compete with. And I think it might be reflective of all of the late stage money chasing returns more than it is necessarily that their business grew double in value.
Yeah, I'm trying to pull up this graph here. So this graph shows this is where Stripe was in January. You can see it right around $22.5 billion. Adyen is the other big competitor, kind of mobile first type of payment competitor. And that's a European company. And they had a fundraise earlier this year, Adyen did, which then kind of brought their valuation even keel with Stripe's. Now Stripe has raised another $250 million on a $35 billion valuation. They're giving up less than 1% of dilution for $250 million. And, it seems to me kind of like they're probably setting themselves up to just do a direct listing rather than an IPO.
That might be right.
And, there's been a lot of news from Bill Gurley, Benchmark, and others where Slack did a direct listing. They didn't do an IPO. And that IPOs are basically, if you think about IPOs are basically you go around to a bunch of bankers and you do a very manual process where now you have to work with bankers. So other banks that are then going to agree to, have investors buy your stock at the initial public offering. And you are going to raise money as a part of the initial public offering. So you're going to issue new shares in the company, which would give you some dilution. And you have to figure out what that strike price is for the stock at that public offering. And the media always kind of heralds IPOs that are underpriced in the sense that, if you IPO at $20 and then the stock jumps up to $30, everyone kind of considers that a win. Unfortunately, it's not a win for the actual company that's IPOing.
Right.
And essentially it's saying that it was mispriced.
It basically, and they could have gotten more capital if they'd priced it properly.
Exactly. And the reason why you're doing this is because it's a manual process where you're basically having to, you have some models, you have some smart analysts, but you're really then just basically working with the banks and how much demand there is, how much interest there is in them purchasing your stock and the new options or the new shares that you're issuing. And so Bill Gurley and others have really come out against this because not only is it an inefficient way to appropriately price the value of a company, but it's also loaded up with a bunch of fees from the investment banks that are then helping to facilitate the actual banks to actually do the IPO. All that is said is to say that the direct listing is then algorithmic. And it actually just relies on a much more purer way to balance supply and demand, where you have basically like a blind Dutch auction. And basically you are enabling all buyers and sellers to match in a blind matchmaking process.
You're not raising new money. So you're just listing the shares. You bring quicker liquidity to some of the folks on your team. And
Yep.
Yeah.
So yeah, it gives you liquidity. It now helps your employees, where if your employees have shares, they now have liquidity to divest those shares or monetize those shares if they've been locked up for many years and waiting to do that. So that, you know, there's different pros and cons to the two different approaches, but you're definitely seeing the direct listings get more momentum amongst the tech community.
Particularly companies that don't need capital.
Yes, that don't need to go.
If we don't need the capital, why are we going to go pay a bunch of fees to bankers if we can do this much cheaper? And really what you're looking for in that case then is an exit event in liquidity for your investors and your employees. And the direct listing gives you that without having to go raise money and potentially pay a lot of money to some investment banks.
My prediction is that Stripe will definitely do a direct listing rather than an actual IPO. Hi, this is Alex Mozed. Thanks for joining us on Winner Take All. If you enjoyed the content today, which I bet you did, please comment, subscribe, and definitely message me on Twitter when we're doing live streams. Also, please note, all opinions expressed about stocks or public companies on the show are exactly that, opinions. This is not investment advice. Don't act on it. WisdomTree licensed Applico's Platform Insights data product to aid in the creation of the PLAT ETF. Thanks for joining us.